House prices fell in the month of February in most capital cities around Australia, but if you're a homeowner or investor, no need to worry, no need to panic. The overall fall was less than 1%, but let's dig deeper into the information, which is what I'm going to do in this month's end of month Property Insider chat with Dr. Andrew Wilson. If you want to keep up to date with what's happening in our housing markets, please subscribe to this YouTube channel and click the little bell icon so we can let you know each time a new show comes out. It's hard to believe we're at the end of the second month of 2025 and it's time for our housing market update for the month of February. Of course, it's old news now that the Reserve Bank's lowered interest rates, but the flow-on effect of this hasn't really had a chance to work its way through the market statistics yet. So to see what's been happening in our housing markets, I'm looking forward to our regular end-of-month chat with Dr. Andrew Wilson, Australia's leading housing economist and chief economist of My Housing Market. Hi, Andrew.
Yeah, good day, Michael. And as you said, it's just happened, that interest rate cut. So we will await the tangible evidence of its stimulus to the market. But look, it's come at the right time. It's interesting. I think our housing markets are very much similar to where we were back in 2017, which, following a strong period of growth, we saw the sort of the cyclical outcomes start to moderate. We're seeing that now. And if we remember back to 2017, we'd actually come off, at that stage, a record period of steady interest rates, which the Reserve Bank now looks back and sort of regrets because they had to reverse that steady rate environment because they kept telling everybody rates were going to rise. And in fact, they slashed rates in 2018, 2019. Or 2019. So it's a bit similar to that. We've had a steady period with interest rates. Last year, they were flat for the full year. And that means that affordability started to wane because we didn't have either lower interest rates or higher incomes, significantly higher incomes, to keep pushing up house prices, which have certainly been pushing up for the last couple of years and in some markets quite substantially. So we're sort of at that point now where...
It was unsustainable, the levels in some of the states, wasn't it, Andrew?
Well, I'm not a great believer in the notion sustainable for housing markets because I think that our banking system allows our housing markets to be sustainable because you can't overborrow. You know, they're very strict.
I'm sorry, I meant the rise, the 20 double-digit growth rise is unsustainable.
Well, that's right, within the boundaries of lending conditions that we have. So you can sort of catch up after a while. We lost a lot, of course, of potential affordability when we had higher interest rates in 2022. The market caught up in 23, 24, and it's sort of caught up now. But we now have a boost to the market with lower interest rates. And the interesting thing is that unlike other periods where we've seen interest rate falls, which do generate higher house prices, we've got a very, very strong economy at the moment, Michael, which is makes this interest rate cut quite extraordinary because previous interest rate cuts, the beginning of the cutting cycle, came when the economy needed to be refreshed and refueled. But now we've still got very strong activity in our economy, particularly our labour market, which means the drivers of housing are still very strong on the demand side because of a strong economy. And of course, on the supply side, we're still not building enough houses, Michael. So, it still looks pretty promising for more prices growth this year. Although, as we know, history tells us, the minute that we start to see those waning house price figures, it does create some problems with confidence. There'll be a lot of headlines, I'm sure, around the place espousing doom and gloom with house prices falling, etc. And that will work.
Well, there'll be the pundits out on the social media saying, I told you so.
Yeah,
it's a Ponzi scheme. It can't keep happening.
Yeah, that's right. And and next month they'll all be saying, oh, well, it didn't happen, but you wait till next year. And we've been seeing that for decades, Michael. So heaven help those that have listened to the doomsayers because they certainly would have lost a lot of money. And I'm not sure they would have enjoyed being in the rental market as their option for the last decade or so. But on we go. It's the same old song. But those figures today, as I said, will work their way into those headlines, which will have the media rubbing their hands together at declining house prices, but it is a cyclical downturn. But of course, we are in February, Michael, and this is, we also have significant seasonal impacts on house price growth. We're coming through, and this is quarterly data that we're looking at, the February quarter versus the January quarter. And of course, that does include January and December, which are our big holiday months. We certainly see significant reduction in demand, and we also see a significant reduction in the number of higher priced properties in the marketplace as a proportion of total properties being transacted. So that means there's downward pressure on prices as a result of those seasonal effects. We at My Housing Market adjust for that. Our model is self-adjusting, but you still can't take away the fact that there are significantly fewer numbers of properties being sold and a significantly lower proportion of higher priced properties. So there's our two driving forces: affordability as the cycle peaks, and also seasonal effects. But let's have a look at the data, Michael, and
Let's start with houses, and then we can look at apartments.
Well, houses, national house price was down by 0.8%, Michael, over the February quarter versus the January quarter, down to 1,150,730. It's the first time since January 2023, Michael, that we've had consecutive declines in the national house price, capital city house price. And of course, if we go back to that period, and also it's the strongest monthly decline that we've had since September 22. And if we do backtrack to that period, that was when we were going through a period of significant interest rate increases, which acted to impact negatively the housing market. So down for two quarters in a row on a month-by-month basis. And certainly for the first time since January 23, no surprise, of course, January 23 was also impacted by seasonal effects. Adelaide, Darwin and Perth were the only capitals to report higher prices over the February quarter. And they were just higher marginally, Darwin up by 0.6%. Adelaide and Perth up just by 0.2%. All the other capitals reported falling house prices over the quarter compared to the previous monthly quarter. Melbourne down 0.6%, Hobart down 0.8%, Sydney lower by 1.1%, Brisbane down 1.2%. Melbourne, although continuing to fall, Michael, is actually sort of more trundling along the bottom rather than falling. So it shows it's not really an affordability issue in Melbourne. It's just that, as we've discussed, that sort of lack of confidence in the Melbourne market, rather than the peak of the cycle, as we're seeing in the other markets, Brisbane, Sydney, Perth, and Adelaide. And even when we look at the results for Perth and Adelaide, those other capitals, they're certainly underperformances compared to recent results. So they're also showing, the impacts of affordability declines and also some seasonality as well. But seasonality particularly affects the Melbourne and Sydney markets because they have very strong prestige markets, whereas the other, as a proportion of the total market, other capital cities don't have that same impact from prestige market activity. So, but when we look at the annual results, they're still quite strong. Perth up 19.4% still over the past year, Michael. Brisbane up 9.9%, Adelaide up 8.6%. And just to reinforce how strong the cycle has been, Perth house prices have increased 42.6% over the past 2 years. Brisbane up 27% and Adelaide up 24.7%, and Sydney up 13.7% over the past 2 years. So this just sort of reinforces that strong growth that we've had through the cycle, and that we're now starting to see those affordability barriers just easing growth. But when we look at units, by contrast, they were actually higher over the February quarter compared to the previous January quarter, up by marginally just 0.2%, Michael. But they didn't recover what they lost in January. So even though it was a bounce back in units, it was only a marginal bounce back, and it certainly didn't bring itself to where it was at the end of last year. So signs as well with the unit market that they're also facing some headwinds, some affordability headwinds over into 2025. The top performer over February was Perth. Of course, these are smaller markets. Perth, Adelaide are smaller unit markets. But Perth was up by 1.9%, Adelaide up by 0.8%. Brisbane continues to grow. That's a consistently strong unit market, Michael, that Brisbane market up by 0.4%. Sydney basically flat, just up by 0.1%, and Melbourne prices were steady. So some better news there for units, probably a more stable outcome, but again, not recovering the what was lost over the previous January quarter, Michael. So again, when we look at the annual results, very strong for those, I guess we call them the big three. Brisbane unit prices up 23%, Michael, over the past year. Perth up 20%, Adelaide up 16.2%. And Perth unit prices, as I said, they're smaller markets. They tend to be more volatile depending on the mix of units coming through. But Perth up 42.9% over the past 2 years. Brisbane units up 41%, Michael, over the past 2 years, and Adelaide up 37.6%. So that is extraordinary growth. And as you probably rightly said, unsustainable growth at that level. And that's why we're starting to see a levelling off now. But, you know, the big picture is that these were expected. We've seen signs of this coming into the marketplace. Very similar to what we saw, Michael, in 2018, following strong growth in 2017. And flat interest rates there acted to push the cycle sideways.
I just wanted to remind you that this is not specific investment advice because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of the opportunities the current property markets are offering. So why not have an obligation-free chat with one of the wealth strategists at Metropole to discuss your goals, your options, and what you could do. We're much more than just another buyer's agent. We help you safely create intergenerational wealth through strategic property and wealth advice. Remember, property investment's a process, not an event, so you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a home, go to metropole.com.au and organise a time for an obligation-free chat. You're going to find that at Metropole we're big enough to tip the scales in your favour, but still small enough to care. And since we don't have any properties to sell, our advice is independent and unbiased.
We did get a period of almost hysterical predictions through that 2018 period in terms of the prospect for house price growth in 2019. The economy wasn't as strong, but I think, you know, the underlying drivers still remain positive for housing market activity this year. We're clearly still undersupplied. There's been no change to that. Even though migration levels have been eased by the government marginally, I don't expect that also to have an impact on demand. And of course, we have a lower interest rate, Michael, which is, in a sense, just at the right time to refuel these housing markets.
Well, we're now going to wait for confidence to come back into the market. And if we want to understand how people are feeling, I know every Saturday you report the auction clearance results. We discuss them every week in our Property Insider chats, and I report them on Property Update. And the first few weekends of the year have given us a reason to be confident that property values are going to continue to rise because despite more properties being listed for auction, the more depth, the buyers are there and auction clearance rates have remained strong.
As you said, Michael, even though we've got these lower results for February, auction markets have started the year off on the front foot. They are a positive forward indicator for market activity and certainly continuing to track ahead of where they finished last year. In fact, Sydney and Melbourne are actually tracking ahead of where they were a year ago in terms of auction market activity. So that hasn't worked its way into the February figures, but I'm sure we'll start to see that going forward into March. But interesting times ahead. When will we see a bounce through lower interest rates? But the real fear for significant or longer term falls in housing market activity is a shakeout in the economy, Michael, and there's absolutely no sign of that happening at the moment.
Well, as you say, everyone who wants a job can get a job. Wages are going up, and there's just not enough accommodation. So that's going to underpin our housing markets, especially when confidence continues to return. So while the 0.25% drop may not be enough to rekindle the flailing Melbourne market. Hopefully it's going to bring enough confidence to now actually just let it find its floor and wait to see what happens. We'll be back each week with our regular Property Insider chats. Thanks, Andrew.
Thanks, Michael.